Welcome back to another video. We're going to be discussing a very interesting and important topic today. We're going to be talking about the 4-year cycle. It's very important to be talking about this now because I think everybody knows that we're actually, if you believe in the traditional 4-year cycles, that means that it's already finished. That means that it's already, the time to sell has been over, and that would be in a bear market. So that's the traditional 4-year cycle theory. And of course, we had quite a drawdown, and a lot of people, I would say most people, are on the camp of the 4-year cycles, and they think, it's downwards from here. So very interesting to actually research this, because it depends on if you're going to be keeping your crypto or not in your strategy in the coming years. So we're going to be talking about making a case for why this is actually not the case, and why it has in the past been different reasons for we had this, what it seems like a 4-year cycle. So I have lots of analysts, and we're going to be going over some videos and we'll giving you my opinion on this. So first, a very short explanation about what the traditional 4-year cycle means. Basically means it's talking about the halving cycle. Of course, we have a Bitcoin halving cycle where every 4 years the amount of Bitcoin that can be mined gets halved. So miners only get half of the Bitcoin which they get before, which means less pressure, of course, on the current supply, on the sell pressure, on the potential sell pressure on Bitcoin. So previously we have always seen rise leading up to that halving, and explosive rise, especially after the period, the 2 years after the halving. So that's why, most people come to say, okay, so this is just how it works, and this is going to be the same thing playing out again this time. There's some slight differences also this time for this halving, is that basically the amount of Bitcoins, it keeps getting halved and halved. So the amount of Bitcoins that coming in circulation starts to become so less that the effect that it has on the supply is becoming very little. So that's one important case to going against the 4-year cycle narrative from this point onward. So even if you believe in it, the last cycles, you could make a case for, okay, now the halving, there's so less amount of Bitcoin coming into circulation that the current halving doesn't, and the upcoming halving don't even make sense anymore to see from a cycle perspective. So that's one thing. But this video is going to be talking about more important things, actual reasons of why previous cycles had another underlying reasons. And we're going to be diving in first to the video here of Raoul. This was actually 6 months ago. So very interesting, the timing of this, as you will see in the video. He's talking about this. He's saying we're in a business cycle, and that the cycle is not over yet, that we yet to have seen the expansion phase, or he calls it the banana zone. So let's dive into the video right away, and I will give you my commentary on it.
It's not a mystery. It is a repeat of the debt cycle. They are rolling the debts. They are doing the same thing. Each cycle is not to do with a halving cycle, nothing to do with any of that. It's all driven by liquidity cycle and funding of debts. Each phase, we get phase 1 of the banana zone, banana number 1, the corrective zone, banana number 2 comes, another correction, banana number 3. So this is the banana zone. So that's what happened in 2020, 2021, off we go. Sorry, that was 2017, which again looked very similar to this one. That was the last one. Here we are now. Finally clearer to me. I'll show you the macro evidence, the technical evidence, the sentiment evidence. Everything here suggests to me that hold on to your hats. Don't fuck this up. Don't lose control of your tokens. Don't use leverage. Don't get your wallet hacked. Just sit with it. Be careful. Don't get FOMO. Do all of the right things, and we will go up to the next phase of correction reserve. That's going to be harder because the next one that happens, we'll have a 35% drop, and you all say, is it over? You'll definitely be sure it's over, and everybody on Twitter will tell you it's over, and it won't be over. By our work, we suggest that because of the elongation of the business cycle, because rates were higher for longer, the forward-looking liquidity suggests that, again, probabilistically speaking, without any guarantees, this whole thing goes into Q1, maybe Q2 of 2026, which would align with Trump's, trying to win the midterms as well. So everything's lined up for us. I think it started. So keep the faith, keep building stuff, and let's keep driving Siri forward with all of this.
Yeah, so very interesting video. The first thing that I want to point out is, of course, the visual aspect. If you put these charts next to each other, you can really see that they're very similar in a way, and that if you put it like this, that we actually had not had the whole banana zone yet. So he's saying the best is yet to come. He's also talking about the big correction and that's, you could be saying this is where we're actually in right now. We dropped a little bit over 30%, and a lot of people are saying it's over. You just have to open X, and a lot of people are saying, okay, that was the end of the cycle. The top is in, and they're talking about the 4-year cycle then mostly. And they're saying that's the reason, it's over now. So then he's talking about a few different reasons. Why is this not, a regular cycle? He's talking about basically liquidity driving the markets. And that's something that's always been the case. And he's saying, there's several reasons for this. First of all, we have the Federal Reserve ending quantitative tightening. They just did it at the end of this month. And we could be seeing, there's a possibility we could be seeing quantitative easing somewhere in the beginning of 2026. So there's several reasons. We have including the PMI index, which is very interesting. I'll be showing you that in a minute. That's a very important index. It's called the Purchasing Managers Index. It's a key economic indicator showing business health in manufacturing and service sectors. So I'll be showing you that in a minute. This is Raoul Palstake, very big strategist and analyst, and I wanted to include his opinion on there. So next, dive into Ron Neuer from CryptoBond. They're one of the biggest crypto channels on YouTube. And he's talking about the same thing. He's saying the 4-year cycle were a lie. The real bull market only starts now. So the top did happen for Bitcoin exactly at the time of the 4-year end cycle. And that's why a lot of people actually thought it would be over. But he's saying the uncomfortable truth is that the halving was not the drive of the last bull markets. And he's giving an explanation. Well, 2013, we had Fed quantitative easing. 2017, of course, we had a massive altcoin season then. And there were also several factors that were, reason why there would be more liquidity came into the markets. We had the ECB, the Bank of Japan and China putting stimulus into the market. And then, of course, we had the biggest case. This was the biggest QE in history. We had the COVID era. So we had this massive crash in crypto at the start of COVID, and that turned out to be, the biggest bull run for crypto almost. So I don't think many people can go against at least the 2020 narrative. It was very clear that the liquidity was driving that pump and basically massive amounts of money printing. So he's saying every time there was a global liquidity surge, economy expanded, and this flowed then into crypto. So he's talking about the PMI as well. So this is a very important one that keeps coming back. And there are several numbers here that usually point towards important phases in the market. So where we want to be looking at is a PMI above 55 means Bitcoin is the first one to go. PMI above 60, that's when the real magic happens, and he's talking about altcoin mania. So the reason the cycle was so disappointing is that the cycle broke the pattern, the halving happened, and I think a lot of people are disappointing. Of course, there were many altcoins that did run, the Bitcoin run, of course, but overall it was very disappointing. If we compare altcoins against Bitcoin, has been quite disappointing, the performance. So the Fed was still draining money through quantitative tightening, and the quantitative tightening has now ended. He's saying this here as well. Rates are also going down, liquidity is turning, and the PMI is bottoming. Of course, we have institutions that keep on buying through ETFs. So all reasons why this previous theory of the 4-year cycle could be wrong. So he added the chart there, and this is a very important chart that I wanted to include. So this is the PMI index. So you see these periods of liquidity expansion. First, this was in 2017 where we had a big bull run here. Then, of course, we had this expansion here during the COVID. Since the start of COVID, we had this massive expansion here in the PMI, and this when we also had this mania. And it's actually very interesting. So now we have, of course, Bitcoin had quite a run already, but you see this PMI index is still very much in the red, very low. So this makes this very strong case that if we see this PMI going up again in 2026, that then is where we're actually going to see the real liquidity coming into the market. So very good post there from Ron from Crypto Banter. So then I got another analyst lined up, very big name, Arthur Hayes, supposedly a billionaire already. He's made a lot of money in the markets, and he has a very good knowledge about the crypto market. And he's talking here about the same subject. He did an interview with Altcoin Daily, and I'm going to be showing you a short subject of the video, and then I will give you my commentary on it. So let's dive into it.
Even if the bull market, in general, not just crypto, bull market isn't over, we're late cycle. It's closer to the end, and it's time to start thinking about de-risking, even if we do have a couple more months, 6 months of up. Would you say, generally speaking, we're late cycle, or we've been in the bear in 2026 starts the new cycle?
I think that we are at the end of the beginning of this cycle, and the massive amounts of crazy bull market money printing is ahead of us. And what informs my opinion on that is the Republicans in the United States have an election to win in 2026. They got their ass kicked in a few specific elections this November, New York City, some other states, and the governor's races. And the message was affordability. The message was, where's my goodies? And so they've got to go back to the well and, print some money and hand it out, just like the Democrats are going to do in their cities and their states. And so it's all the same program, at least in the United States. It's printing money. In China, they're battling the deflating housing market. They're not going to go as crazy as they went in 2009 and 2015, but they are going to add stimulus to their economy to make sure that the housing collapse is managed appropriately. And at some point, we'll see maybe all the deflationary impact of AI in China prompts general angst, and they print money to mollify their population as well. Over in Japan, the new prime minister just launched one of the largest stimulus programs since Abenomics about a decade ago, however long he was in power. And so we have stimulation in Japan, in Europe, because they're afraid of Russia for some nonsensical reason. They're going to print a bunch of money to build up the military, and that is going to print money in Europe. So I think that the fireworks are just beginning in terms of what assets can do. And I think that the upside is under-owned by a lot of institutional investors. I think retail investors get it, right?
Yeah, very interesting subject. He's saying we're at the end of the beginning. So he's actually saying we're actually about to see a start of a lot of money printing. So he's coming back to the point that liquidity that's driving the market. So he fully goes against the 4-year cycle perspective here. And he's talking about several factors that's going to drive liquidity. First of all, we have the USA with midterm elections coming up. Of course, we have Trump also talking about dividends on tariffs, which basically going to be stimulus checks. He already said that we're going to give that in 2026. We had those stimulus checks, part of the COVID printing as well, 2021. And that had a very good impact on the crypto market and financial markets in general. Then he's saying also Japan, China, and Europe have also reasons to be going to the money printers. So that's what you want to be seeing if you're invested in assets. Of course, if you're in, you only have fiat, this is usually not a good sign, because what comes along with it is probably some more inflation, but that is a worry for later. First, we want to see our bags go up, of course. So very good analysts here. Arthur Hayes talking about the same thing. He's going against the grain here, and he's completely disregarding the 4-year cycles. And he thinks that we're about to start of a big run. Then let's go over to some expos. We have Quinton Francis here. This is another chart that I wanted to include. This is a very old chart, I think almost 100 years old. And this is talking about longer cycles. And the reason I wanted to include this, because it's been very accurate in the past times. So this is more longer cycles. So there were we have on top, we have A years in which panics have occurred and will occur again. So very good times to buy. Years of hard times, low prices, and good times to buy. A is actually a good time to sell. I mean, that's not after A, of course, we go to C again, but and then B are years of good times, high prices, and times to sell stocks and values of all kinds. So we see here the cycle of 2026. So it's another one that points out this 2006 importance. So it's not the end all, of course, but I still wanted to include this perspective here, which is quite interesting. Then we have Louis van der Cliff talking about the same thing, about the PMI. You really see this picking up attention here, especially on X. A lot of analysts are talking about it simply because it's so clear in the charts. He did an overlap here on the PMI index, and you see these periods of PMI going down points to a bear market, which has been very clear, and this upwards movement. And right now, the market, Bitcoin, has been driving upwards. So you would say, okay, this should be the bull run, right? We should have seen the PMI go upwards, but it's not the case at all. And this also points to altcoins being stagnant. So very interesting. Then he overlapped the Q quantitative tightening end and quantitative easing start, and quantitative tightening ending usually does not say too much yet. It's important, of course, but the quantitative easing starting is more important. And that's a big possibility that we're seeing that in 2026 for a specific reason also that I included here. So let's go back to Arthur Hayes. He's talking about this subject. So let's dive into it.
Can get a voting majority on the Fed Board of Governors, who control the interest on reserves and some other rates within the U.S. economy, which leads into a majority on the Federal Open Market Committee, which determines the Fed funds rate, which everyone's familiar with, and sort of the Fed balance sheet policies like quantitative easing or quantitative tightening.
Now, Trump is getting control of the Fed in 2026 regardless, because he's picking the new Jerome Powell, the new head.
Not necessarily. Jerome Powell is just one vote. I know people think that because whoever the Fed chairperson is, whatever they say goes, but technically speaking, the Fed Board of Governors is a 7-person board. You need 4 votes. The FOMC is a 12-person board. You need 7. And Powell or whoever replaces him is just one of 7 votes, even though previously, from Volcker until Powell, it's whatever the chairman wants. But now we're actually starting to see some actual dissent in voting in what the members want to do. And so now it's anyone's call as to who gets 7 votes, the doves or the hawks.
So after Jerome Powell gets replaced, Trump will undeniably have 3 out of 7. To get that 4th, what needs to happen?
So we went after Lisa Cook for mortgage fraud. She refused to resign. We'll see what happens there. There's elections for the board governors, the board presidents. So there's 12 districts in the United States, 12 central bank districts. Each district president rotates on the FOMC. These presidents, except for the New York Fed, are all up for re-election in February. And the Fed Board of Governors, if Trump can get control of that, can control who becomes a sitting president who rotates as a voting member on the FOMC. And so there is a way, if Trump is able to get 4 out of 7 votes on the Fed Board of Governors, for him to control who gets appointed in February as the presidents of the relevant district, Federal Reserve district banks.
From your point of view today, how likely do you think he'll get 4 out of 7?
I put a 90% confidence interval that he'll get what he wants. And the reason I say that is because regardless of the political party, since 1913, every single U.S. president has always got the monetary policy that they desire. And people just haven't studied enough history to understand that this sort of contentious clash between the Fed and the president is a standard operating procedure for U.S. politics. The president is always bashing the Federal Reserve for cheaper, more plentiful money. And the Fed tries to play this, game of, oh no, I'm not going to do that because I care about, the sovereignty of the dollar and Fed independence. But over time, every single Fed governor, Fed president always does what the U.S. president wants. Trump will get the monetary policy he desires come hell or high water.
Yeah, so he's talking about something that's likely going to play out next year. He's giving it actually 90% chance that Trump basically gets his picks on the Federal Reserve, and that means he has a lot of control, and that means that the money printer simply is very likely to go on again. So this is another aspect that we really want to be watching closely. We know always Trump is the one that wants to simulate the economy. Whatever you think of it, or whatever your opinion is on it, it's good for the markets in the short term. So that's what we're going to be watching in the beginning of the next year. We're going to be seeing how this plays out. Arthur gives it a 90% chance actually that he's going to get what he wants. And further in the video, he's talking about a prolonged bull run. Actually, most people will say, even the analysts who are not talking about the 4-year cycle, they mostly say, Q2, Q1 2026. But Arthur is actually talking about near the end of the presidential election that we're going to see a run up, continue with bull run to that. So that will be very exciting, of course, if that happens. I don't think a lot of people are expecting that. But it's not always what happens, what you expect. It's usually the opposite. Okay, so that's been this video. Let's see. Also, I wanted to include a post here from Hunter Horsley. He's talking about the psychological aspect here, because so many people believe in the 4-year cycles, and they believe that 2026 will be a bad year. So the first order effect, people already sold in 2025 to avoid the down market year. And that means the second order effect is the 2025 sellers. They cause 2025 to be a down year, just breaking the 4-year cycles, because 2025 is supposed to be, according to the 4-year cycles, a top year, at least also for altcoins. And that simply wasn't the case. For altcoins, it was a lot better at the end of last year. So he's saying the third order effect will be 2026 open seasons, 4-year cycles broken. So very interesting post in regards to more the psychology aspect of the markets. So we have Ted Pillows. I've been to this already. He's overlying the charts again, which is very pointing again towards liquidity coming in, and that's what putting the bull markets. Then the last one, I included this already in my last video about the market updates, and here's where we're actually seeing, if we're looking at altcoins compared to Bitcoin, is we're seeing we're not in a bull market at all. We're actually at the bottom of a bear if we're comparing it to Bitcoin. So this is a very interesting perspective. We see this when we hit this line, we already hit this during the liquidation crash, and it was the start of 2017 alt season, 2019 DeFi season, and of course the massive money printing for the 2021 altcoin season. Combine this with the falling wedge, which usually break out to the upside. Things look good in my opinion. All right, so that was the video. I think it's an important video to make a topic about it. It can be quite controversial, as most people believe in the 4-year cycle. I want to know your opinion. Let me know in the comments. What do you think? Do you believe that the cycle is over and we're heading to a bear market in 2026 and the top is already in? Or do you believe the best is still to come for altcoins? All right, that's it for this one. If you had some value from this video, make sure to subscribe. I'm trying to put time and grow the channel. And really appreciate it. So that's it for this one. Have a good day, everybody.